Well, hey there, everyone. Welcome to Chart This with Dave Keller. Great to be back here with you. I'm your host, Dave Keller, coming to you from a kind of perfect October day here in Redmond, Washington. Great to be back. Apologies for just completely torpedoing my plan. I had a plan. I had a strategy for what to do with this show while I was gone. The plans just evaporated right before my very eyes. I had a wonderful visit with my daughter who's going to boarding school in Michigan. It has been a huge adjustment for my family. It was awesome to be back together. We had a lot of fun. If you subscribe to my YouTube channel, which you obviously all should if you haven't already, I shared out a picture of my family and I right after her concert. And it was awesome to see her. Great to hear her perform and meet some of her friends and all of that. We had all these great plans to get back here through Chicago yesterday. Weather, air traffic control issues caused some changes to that plan. So the bad news is, did not get back in time to get a show for you. The real good news is, I'm here now, and I'm super excited to be joining with you, sharing some charts and insights with you. If you're new to the show, welcome. Thanks for those of you that are tuning in live. You have the opportunity to ask questions as we go along. Please take a moment. If a question pops in your head and pop it into the chat. I'd love to hear from you. I can see all those questions as we stream live on Facebook, LinkedIn, YouTube, and X. If you're watching the show later on our YouTube channel, thanks so much for watching there. And just drop a question when you can. We are planning an all mailbag episode on Friday of this week, and we would love to answer one of your questions there. Didn't get a mailbag episode last week, so we got some really good questions. We could always use a couple more. Thanks so much for being here. Let's get to the charts. No more intro. Not a great, return to the show in terms of the red that I'm seeing on my screen. You can see what's interesting about today. We actually had a higher open. The S&P did push briefly above 6750, and then it was all rotating to the downside. The S&P bounced off of the 6700 level right around lunchtime Eastern, ended up finishing back up around 6715, and that's where the day ended. That pushed the S&P down 0.4% for the day. The NASDAQ Composite down 2/3%. The Dow slightly lower, about 0.2% for the downside. The S&P mid cap and small cap indexes, both in the red. The S&P 600 small cap index down 1.3%. That's your worst performer. Volatility pushing a little bit higher. So the VIX now above 17. With the VIX in the teens, we're in a low volatility environment, particularly the VIX in the mid-teens. When volatility pushes higher, the VIX gets to the upper teens, and then especially when it gets above 20, that's less of a low volatility environment. That would be a major league red flag for me. I'm often asked in this sort of environment, like, what would you look for that would get you concerned? And my three answers would be, if pressed. One would be a breakdown in the S&P. That's obviously one of them. Number two would be a spike in high yield spreads, meaning credit spreads are widening, meaning bond investors are getting nervous. We're not seeing that yet. Number three would be volatility spiking, which would tell you the options market are indicating investors are getting nervous. That's not happening either. At some point, those things will most likely happen. And please continue to tune in. We'll keep you updated when we see those sorts of warning signs. But the VIX moving higher as the S&P closes lower today. So the VIX around 17.25. We're still okay. We're still in a low volatility environment. That's an important chart to watch this week. And certainly as we get into earnings season here over the next week or two, because that's where volatility often accelerates. That's where we could find a big red flag waving. Again, so the S&P not too far off of all-time highs after yesterday's move higher. Today sort of giving back Monday's gains. Looking at the yield curve, we're generally drifting lower today. The 10-year point's around 4.13, we'll call it. The long bond yield around 4.75. The 5-year point around 3.7%. The short end coming down as well. It's kind of everything sort of easing off here. Bond prices rotated higher today. So this is sort of a classic safe haven kind of day with stocks moving lower, bonds and the dollar moving higher. Sort of indicates more of a move to safety. We'll see that as we get to the sector performance today. Very much a defense over offense type of day. Type of day we haven't seen a lot of here, certainly in the month of September and so far in the month of October. Looking at the commodity space, slightly higher for the DBC. That's a broad commodity ETF. Gold up about 0.5%. The GLD pushing upwards. Gold briefly pushing above $4,000 an ounce, right at that key point That's a significant move. And I remember when gold at 2,000 seemed ridiculous back in the day. Here we are at 4,000. The uptrend in gold has been remarkable. The GLD pushing further today. Silver actually lower. The SLV was down about 1.5%. So a bit of a disagreement between those two. Energy doing all right with the USO up about 0.5%. Energy sector had a decent day as well. Cryptocurrencies, right? So Bitcoin yesterday, and again, had we had a show yesterday, we would have celebrated Bitcoin making another new all-time high. We're above 126,000 yesterday, but today we're back down around 122,000. So we're still within the range of those all-time highs. And we're seeing breakouts in Bitcoin, certainly breakouts in Bitcoin-related ETFs. Coinbase is one of the stocks that I grabbed today. Maybe a bit of a toppy move in the chart of Coinbase here. We'll take a look. But as you can see, the top 10 coins tracked on the stock charts platform, all in the red. I should mention, by the way, on gold, it's not published yet, but should be out here later today, maybe tomorrow for Stock Charts TV. I do a weekly show there because of my trip. I had to postpone it, do it today. It was all about gold, all about the long-term history of gold, the recent acceleration we've seen in gold, how gold and silver had compared to other asset classes, how gold stocks have related to other stocks, and some trend following techniques looking at Newmont Mining, the GLD, and others. So keep your eye peeled on Stock Charts TV for my weekly show. Should be out here pretty soon. I'm guessing tomorrow morning they'll get that out. Looking at the 11 S&P sectors, really kind of dead even right now. 5 up, 6 down for the day. You can see consumer staples, utilities, number 1 and number 2. Now, those are probably the two most defensive sectors. Maybe you could argue about whether real estate's more defensive, but I feel like that's just splitting hair among defensive sectors. These are two fairly defensive sectors, and consumer staples have been underperforming consumer discretionary for longer than probably any of us would have guessed. At least certainly as I have. Right, consumer staples have been underperforming. Defense has been underperforming offense. Today, you get the bookmarks. Consumer staples up about 1%. Consumer discretionary down 1.8%. Some of the big names in consumer discretionary. That's a top-heavy index dominated by names like Tesla. Not a great day. Amazon struggling here recently. So kind of the big dogs within consumer discretionary feeling the weight here. And so at least for today, defense over offense. That ratio is the offense to defense ratio. We're going to keep an eye on that to look for a potential rotation lower, certainly moving lower today. Utilities up 0.5%. Energy and financials up slightly, as was healthcare. On the downside, after consumer discretionary, you have technology down 0.2%. Industrials down 0.6%. I did grab a number of technology, couple communications names to watch when we get to the chart review portion of the day. All right, looking at breadth data, not great. And I would say the challenge with the markets here in in September, now into October, has been a lack of breadth support. And as I've mentioned, I think the most encouraging thing I could see, right, when you see a market that's had the run it's had so far, you're looking for signs that there's sustainability, right, that there's an opportunity to continue that advance. And I think you need to see much more breadth data, much more improvement in breadth. And we're definitely not seeing that, right? We're seeing devancers apparently is a mashup of decliners and advancers. Devancers. I guess that's what neutral, that's a new name for neutral. Decliners outnumbering advancers on all the major U.S. exchanges. For the New York Composite Index, about a 2-to-1 ratio. On the small cap S&P 600, about a 4-to-1 ratio. Stocks going down versus stocks going up. So what that tells you is even though the major benchmarks were just down slightly today, most things were down, but it was almost everything was kind of pushing lower, and I think that's a real concern here. I mean, the challenge with this market, as we've covered, I hope exhaustively, and if you've watched the show, you've heard my comments on this. Right? I mean, the challenge with this market is euphoric, FOMO-driven optimism. I mean, just rampant optimism. Getting valuations super extended. There's no denying. I mean, you can't convince me that what's happening with AI-related stocks is not a bubble of some sort. Now, how painful the unwind of that bubble, the popping of that bubble is, how steep of a decline is, that's what I think we'll probably be debating here at some point. But you can't tell me based on the valuations and just the ridiculous extended run that we've seen that we're not way beyond what we probably should be based on any rational evaluation of even the potential of these technologies. It's too much, given the run that we've seen so far in 2025. So what we're left to do is this dual mandate, if you will, of following the trend as long as possible, but then recognizing when the trend is exhausted. That's why our most recent webcast that we just did last month was all about trend following 101 and thinking about the 3 goals of a trend follower. I think this is an important toolkit to keep in mind as we try to navigate these markets here in Q4. All right, looking at the leading growth names, you can see Netflix up 2.4%, Amazon slightly higher, up 0.4%, kind of diverging a bit from the XLY, or at least rallying in the face of some weakness elsewhere. Tesla just getting absolutely clobbered. The news with Tesla, I saw someone kind of updating that. They sort of came up with their less expensive models, and I forget, it's like the Model 3 and Model Y standard or simple or something like that. I think it was standard. Lower cost options, which Musk has been implying for years. He would come up with an inexpensive for the masses type of electric vehicle, because the early ones are obviously incredibly expensive. Market not taking that news particularly well, so down 4.5%. And we saw that with Apple not too long ago. They had the new product announcement, stocks down the day of the announcement. It was sort of a uh-oh for Apple, because no one's excited about their new product line. And then it sort of recovered very, very quickly. So we'll see if there's similar delayed optimism on Tesla when people have an opportunity to sleep on the news. But for now, not a great instant reaction. Alphabet also down almost 2%, which is hurting the communications services sector. All right, let's continue on looking at the market carpet. Special thank you, Larry, for the very, very kind gesture on our YouTube channel. I appreciate so much you watching and sharing comments and being part of this great community. It's fun to have to discuss these markets with all of you guys and compare notes as always. But thanks so much. It's a very kind gesture and super thoughtful, and I appreciate it. All right, shall we continue, folks? Getting on to the market carpet. This is a heat map style visualization. I mean, I don't know about you, but when I get my sort of initial reaction to this is not good, right? I mean, and I think the problem with this market is you have a lot of big names down pretty big, right? Particularly Alphabet, Tesla stand out to me. Oracle down 2.5% today. Outside of those big names, I mean, just not a lot of the large names had a decent up day of any sort today, right? Amazon was up 0.4%, Broadcom up 0.3%, but after that, everything's kind of flat to down a lot. I mean, Netflix had a good day, so that's encouraging. Within semiconductors, I think this is a key story. AMD just continuing to accelerate to the upside, leaving $200 of share in the dust and just continuing higher, closing above $211 a share for the first time. But look at the rest of the semiconductor space. Lam Research, Micron, Applied Materials, KLAC. These are all semiconductor names, ON, that were down today. ON's a little bit different because it's not been quite as constructive, but a lot of these other names have just been accelerating. And while AMD continued higher, the rest of them all kind of hooked lower today. Certainly something to watch. And video was basically just down slightly, but not much. But I think the story in tech has been, semiconductor names just ripping to the upside. That's, they're down pretty big today, although still not too far off of all-time highs. The hard drive manufacturers, Seagate, down 7%, Western Dig down over 4%. These are names that are just coming off of new 52-week highs going into October, and all pulling back pretty aggressively here today. So the danger for this market, particularly when you've had these, vertical accelerations, right? This euphoric kind of exponential rise, right? Look at the slope of Western Digital moving higher. And here's a handy trick, right? We're using a y-axis, what's called a semi-log scale or a semi-logarithmic scale, which means the x-axis, which is the date, is kind of a normal scale, right? Each day has an equal distance. But if you look at the vertical y-axis, it's logarithmically scaled. So the higher the number, the smaller the movement, because it's based on an equal percent basis. So 1% is an equal vertical distance all across this y-axis. So if a chart is just kind of going up at a 45-degree angle or at any sort of consistent angle, that means the percentage gain is pretty consistent, right? When you can just draw a trend line and the price actually just follows this trend line pretty well, that gives you an idea of the percentage return, right? Because we're going up a certain percent every week, and that's what gives us the price kind of matching it. Now, if we keep doing that trend line, look at how the price diverges. That means we're actually accelerating. So instead of like a consistent 1 or 2% gain a week, all of a sudden this is gaining 1%, then 2%, then 3%, then 3.5%, right? It's like gaining more. So the percentages are increasing. That's what it means when the slope increases on a semi-logarithmic scale. That's why log scale is so valuable, because it can help you understand whether we're having a consistent percentage gain or whether we're seeing an acceleration well above that. And that often indicates a euphoric rise, right? We have this exponential rise. And that's absolutely what we've seen. As a result, the moving averages are all spreading out. The 21-day EMA is the slope of that. It's just accelerating. The RSI is overbought, often above 80, which is an extreme overbought condition. So all these signs of a market that's had, an acceleration to the upside. So the problem with that is if you're using any sort of trailing stop, the price is tending to get further and further away from that trailing stop, which often means, it's happened, but it's super rare that a stock will have this exponential rise and then just kind of plateau for a while. What's more common is that you have this big rotation lower because there's all this FOMO making the pace of the advance accelerate. And then when the music stops and we all try to sit down and some of us don't have chairs left, that's when the initial selling rotates lower. That's when FOMO turns into FOLE, fear of losing everything. And that's when markets kind of accelerate lower. So what's interesting is if you go back the last couple of days, this is Western Digital. I'm spending all this time on here. This is today's bar. That's Monday, which means Friday we had the shooting star candle. Thursday we had our highest open, but then we closed down on the day. So from last Thursday on, it's been more of a bearish kind of action in Western Digital. So today's sell-off after Monday's sell-off, not feeling particularly good, and certainly something to continue to watch. But that was way deeper on Western Digital than I wanted to go. But there you go. What else stands out on the heat map here? I mean, for me, it's a lot of different things. Within the consumer discretionary sector, obviously a pretty rough day. And as much as we think, it was probably just the big names that were down, Amazon was actually up slightly, although the chart has been vulnerable here in the last month. Home Depot down slightly. Now that's actually been in a bit of a free fall here for the last 3 weeks. Tesla is the big rotation, coming down on today's product announcement. But look at all the other names that are struggling here, right? We had Nike trying to hold moving average support today, not feeling like that's happening. We've got home builders like Pulte and Lennar, not horrible charts necessarily, but not great anymore, and starting to rotate below short-term support. And what's happened is charts like NVR, which looks so encouraging right about here, all of a sudden breaking the 21-day, the 50-day is in play, and today now that's not holding. So I don't know how optimistic I want to be on a chart like this when it's failing to hold all the moving averages that I rely on as short-term measures of support. So I'm finding a lot to be concerned about within the consumer discretionary sector. All right, let's continue on looking at some charts. Again, I do see some great questions coming in. We'll take a question or two at the end. Please keep them coming. We've got a mailbag, and any of the questions we don't get to during the show, we pop them in there. And of course, if you're watching the show later on our YouTube channel, questions are always welcome. Throw them in the comment section, and we'll hope to answer your question on our next mailbag episode. Here's the S&P 500, bit of a divergence here, although, we were overbought yesterday. Today, we're coming out of that overbought region. So, kind of tells us we're in most likely a bit of some sort of at least tactical pullback here as we continue the first full trading week of October. But most recently, we were overbought here at the third week of September. We had a brief pullback of like 3 days before rotating higher. Remember, all of these pullbacks, we haven't undercut the most recent swing low, and that's been the case since all the way back here in April, right? From that April low, every pullback we've had a higher low, right? We haven't undercut the previous low yet, and at some point that pattern is going to change, and that is when I'm going to have some sort of banner behind the episode, on the shot here, saying breakdown of support, line in the sand violated. I don't know what the name's going to be, but that's an issue, right? If we would no longer make higher lows. For now, we're still good. And that means for me, a pullback to anything above 65.50 is still in really good shape. But if and when we would break below that initial line in the sand, that's the most recent swing low. That's the 50-day moving average. That would be something to be concerned about. For now, we're still, again, yesterday, what was it? Friday, and today we're making, we're testing new all-time highs. So we're still not that far off of those, but something to watch. I did grab a breadth chart, and let me make sure that came in here. If not, I don't know where I put it. Where did I put that thing? Who knows? All right, we'll do it the old-fashioned way. We'll just go to the chart and bring it up. I want to show you the McClellan oscillator. We talk a lot about breadth indicators. I put it in the wrong chart list. That's what happens. All right, here's what we do. This is how we quickly move it to another chart list. There we go. There we go. Ha! Got it. All right. Here's the McClellan oscillator. This is a breadth indicator based on advanced decline data. Been a bit of a divergence here recently with the advanced decline lines. That's a cumulative advanced decline line that measures, every day how many stocks are up, how many stocks are down, and looking at that as a data series over time. In the last couple of weeks here, we've had the large cap AD line, the S&P 500's AD line making a new high. None of the others making new highs, and like the mid cap AD line is actually below the 50-day moving average. That can be reflected in some ways with the McClellan oscillator. This is a breadth indicator looking at basically the slope of the advanced decline line. This is an indicator that was designed to give a short-term breadth indicator and recognize when, particularly, there were disagreements where the market was moving higher on weaker breadth or the market was moving lower on stronger breadth. And we're actually finding that the former right here, where the market has been moving higher last week in September, first week in October, but the McClellan oscillator has remained below zero. It actually almost got above zero going into this week, but so far has remained below zero. And today, this is not updated for today's action just yet, but based on the data, is going to move lower to some degree. So the fact that the McClellan oscillator has been below zero for the second half of September, now into early October, basically just confirms what we saw with the daily advanced decline data. There's just not a big breadth support for these for this move higher, and that appears to have changed a bit here at the end of mid-September toward the end. Now, the last time we had this kind of pattern was back here in the July pullback, which ended up being not that much of a pullback, right? We had like a couple down days, and then all of a sudden we had this nice recovery. About a week and a half later, we're making another new all-time high. So this was fairly short-lived, but again, I equate this to a tornado siren. That's an analogy I borrow with full credit to Adam Koch, a financial planner based in the Columbus, Ohio era, fellow Buckeye, who I've gotten to know over the years, a fellow CMT. When I interviewed him on my podcast, which you should re-listen to if you haven't, or listen to if you haven't yet, we talked about big breadth, breadth warnings, red flags, like a tornado siren, which you have a lot in different areas of the Midwest. You definitely do in Columbus, Ohio. When that siren goes off, doesn't guarantee there's going to be a tornado and that your house is going to be destroyed. But I've learned when the tornado siren goes off, you go down to the basement, right? Just to be safe, just because there's a heightened chance that something really bad is going to happen. And I think the lack of breadth support, sort of like a tornado siren. I don't have a problem with getting a little defensive here, given the fact that I'm seeing signs that are very similar with, topping patterns. If the market keeps going higher, I'm going to be happy owning stocks, which I still do. But it's definitely concerning here as the market's threatening, sort of testing new all-time highs. Here's the chart of gold, and again, I'll let you please, when you have a moment, watch the chart on Stock Charts TV, or the video on Stock Charts TV, because we talked about the chart of gold. Just looking at the long-term history down into the short-term price action, gold touching $4,000 an ounce. When I started in the industry, it was way off the left side of the page. But what's interesting is in the late 90s, the market was actually, the equity markets were going higher, obviously, right, in the tech bubble, and gold was just kind of trending lower, right? For years, there's sort of this big downtrend in gold. And then it started to change significantly. Here, we're actually seeing the opposite. We're seeing the market rallying, the equity markets rallying, but with gold really participating on the upside. which is more like what we've seen after that. Like coming off the 2002 low, like 2004, 5, 6, gold was going higher, stocks were going higher. That's a little more what this feels like with both of those going up. So as much as we talk about gold being a safe haven, and maybe that's part of this acceleration, because we are seeing certainly signs of hedging, which I'm not an institutional investor, but if I was running a big institutional portfolio, I mean, if I had an opportunity to hedge for potential downside, I absolutely would be doing that, whether that was using S&P futures, whether that was using the options market, whether that was using like the VIX futures, right? And just betting on a VIX ETF or something, betting on, a spike in volatility, just as a hedge, right? Not that you're super bared up. It's just like, we've had such a gain, like at some point this is going to end. And I don't want to, just be completely exposed to this market. Peter Lynch famously said, oh boy, I'm going to butcher this quote. I shouldn't announce a quote having not actually looked it up first, but it's something like it's great to be caught with your pants up or something like that, which is basically like, just be ready and be prepared, be vigilant, and just be ready for something unknown to happen, and have those bets ready. So gold overall in an uptrend, our market trend model applied to the chart of gold, consistently strong. Again, there's a spike in gold prices. What I love is that it broke out of this consolidation phase. The push above 3,500 was pretty significant. Now we've had an incredible run. We're up another 500 points, $500 per ounce. Now extremely overbought with an RSI above 80. Again, at some point the RSI goes back below 70. That's going to be the sign of most likely some sort of tactical pullback. Market moving higher on weaker momentum. That would be a bearish divergence. That would make me nervous. Not seeing that yet either. Bitcoin, boy, something to watch here. I was asked about the chart of Bitcoin over the weekend by a media outlet, and shared a comment and shared this chart looking at Bitcoin. What's interesting to me, as Bitcoin has pushed above $123 an ounce, touching just over $126 an ounce, is the fact that on these previous tests of like that 120 to 125 range, we had a big shooting star candle here in mid-July and mid-August. It was a bearish engulfing candle pattern. Here we haven't really had that. We have had some long upper shadows, but no real like bearish confirmation as we test that resistance level. So we broke above the previous resistance, that July peak, for the second time here over the last couple of days. Today having a pretty decent down day on Bitcoin, still hanging in around 122,000, but certainly watching for follow through above that resistance, and a failure all of a sudden means this is in a pullback phase. We're out of the overbought region today, which is similar to what we've seen at previous short-term peaks with the chart of Bitcoin. Coinbase, obviously, as Bitcoin is coming down, is kind of pulling back as well. Coinbase didn't quite get up to $400 a share. The previous high is up here around 440, which we hit in mid-July. We had this gap lower into a low, an August early low, right around $300 a share, maybe 295, we'll call it. We had a number of tests of that level and then bounced higher. And I loved the break above 350, which took us above, obviously, the 50-day moving average, but also took us above this resistance. That's kind of that initial level I would be looking at. That's the 21-day EMA as well. So on a tactical perspective, like that's kind of the point where if this is a nice uptrend and just a brief pullback, that's kind of where you would expect it. Anything below there, I think you have to start looking back at that previous low around 300. Again, similar to Bitcoin, overbought yesterday and pulling back a bit. All right, let's talk about some of the major growth names here to finish out our chart review, along with some other random things that I grabbed. Meta Platforms here, of course, rotating lower. We can see the failure to hold 740. Today kind of chopping around, yesterday chopping around as well. That was after this sort of bearish two-candle pattern that we saw going into last weekend. So yesterday and today holding in right at the July lows. For me, this range here around 675, that's the 200-day, that's the 38.2% retracement. That'd be an initial downside target, I think, still in play. And if that would not hold, I think Meta all of a sudden looks like a very negative chart for now, kind of in a pullback within the context of a bullish framework still. I think Netflix is another one. There are a number of charts kind of testing key support levels. For Netflix, it's around 1140. We had this hammer candle. You actually might call this a dragonfly doji if you really want to get down the list of candle patterns and names That's what that one is, where the open and close are very, very similar. Limited upper shadow, long lower shadow. That's a doji candle. And because the open and close are at the highs, we call it a dragonfly doji. That's a bullish reversal pattern right at the first Fibonacci support. The last two sessions, or the previous two sessions, then tested that same low. Today bouncing off of there. So I think Netflix holding that 1140, 1150 range. Pretty important. Break below that would be pretty negative. Amazon also testing support with the 200-day right around 215. We have some lows over the last couple of weeks just above that level. Holding that, I think, is pretty important. So I think the story of this market, if you want to know how do I confirm we're in some sort of pullback scenario and I need to start thinking maybe more defensively, personally, besides the S&P, I'd be watching Meta, I'd be watching Netflix, I'd be watching Amazon. Charts like this fail to hold the key support that they're actively testing. I think this is a really ugly market very, very quickly. All right, semiconductors all getting hurt today. This is a weekly chart of AMD just to show the fact that we're testing the previous all-time high. I love to look at charts like this when you see something like AMD gapping higher. Obviously, great news. Big upgrade in their ability to be more of a significant kind of central actor within the AI euphoria, as long as that continues. And that's a good thing to be identified as one of those things. But with the gap higher, it's worth noting, you look left on the chart. When in doubt, zoom out. So if you look left on the chart, on the weekly chart, you can see that gap higher basically took us almost exactly to the previous all-time high, which was in the first quarter of 2024, which is right around $230 a share. This week's gap, or really the gap into Monday's session, basically took us right back to that level. And now we're pulling back a little bit through the course of this week. Does this end up being a huge double top on the weekly chart? I mean, maybe. The daily chart is what I would use more actively to think about short-term movements. But keep in mind that gap higher has pretty much been it. Here's the daily chart in case you want to see what happened, right? So we opened here around 225. We closed just above 200 yesterday. Today, an inside day, but again, closing below the open. I'd be watching yesterday's low as an initial level of potential support. All right, let's talk about Tesla. Tesla, obviously, in the news with the lower cost options, the standard edition of the Model X and the Model Y. I had a note somewhere. I don't know what I did with it. Oh, here it is. Found it. With Tesla, right? So gapping higher, or not gapping higher, but trending higher. Gapping higher back here in September. Trending higher, but what I've been noticing with Tesla, it's been weaker momentum. And again, look to the left on the chart, right? I mean, same with AMD, kind of testing a long-term resistance. For Tesla, you just look back to the end of last year, right? December of 2024, around 480, 490 on an adjusted basis. That's literally where we ended up last week with this really ugly bearish engulfing pattern, up day, down day. Day two engulfs day one. That suggests next 1 to 3 bars more likely lower than higher. That has played out pretty well. So this move to the upper 400s has been marked by weaker momentum. That's a cause of a bit of concern here. So I think there's a couple things to think about on the daily chart. The divergence, this uptrend that's testing the previous highs. On the weekly chart, you can see that it's not just the high from 2024. Actually, if you go all the way back to 2021, that's when Tesla hit $400 a share. We then went down all the way down to $100 a share and then back up to basically retest the 2021 high. We did get a little bit above there, around 18% above that level to peak just below 500 at the end of 2024. We're kind of back in the range of the 21 high and the 24 high. So can Tesla go much higher? It certainly could. But at this point, I'm kind of assuming resistance, right? So you have names like Tesla having really good, rallies in September, but now hitting kind of not just a resistance, but kind of like the resistance. So I think you need a lot more momentum to push through a significant name like that. Man, we're going to finish with this chart of Intercontinental Exchange, ICE. And if you don't know ICE, it's not that ICE. It's not the ICE in the news. With the immigration issues. This is the Intercontinental Exchange. I'm sure they wish they had a different acronym right about now. But Intercontinental Exchange Group is the owner of the New York Stock Exchange. I mean, as close as you can get to like classic stock market structure, the New York Stock Exchange, the floor, right, the big board, all of that. ICE basically represents that. I don't know if you noticed, but from the peak in August around 188, the stock has been trending lower, broke below the 200-day moving average in late September, and has continued to finally break below the 61.8% retracement level, which means from a Fibonacci perspective, this chart is pretty bad and getting worse, and it's failed to hold every support level. Now, it's oversold, and just today coming out of that oversold range. So I think getting back above this Fibonacci level around 163 would be a pretty good bounce higher. What's interesting to me, though, do you know what the bounce higher is driven from? Because they announced they're making a huge investment in a prediction exchange, a big crypto-driven prediction exchange called Polymarket. This is about as anti-NYSE as you can get from the big board, right? The big established old school trading floor physical exchange located in downtown New York City, old school, versus prediction markets driven by crypto called Polymarket. And the fact that the NYSE company is making a huge investment in crypto and prediction markets, I don't know what it's a sign of, but I feel like it's not good, but definitely is suggesting that the old school names in what has been a remarkable trend, has been investing in new school names, and what it shows you is ICE obviously has been recognizing for years that managing a trading floor in New York is not much of a profitable business anymore. Although it is in some ways with things like IPOs, it's not doing what it was before. Part of that is how the New York Stock Exchange has basically become a huge TV studio. If you've been there on the floor recently compared to been there 20, 30 years ago, it has a much different feel, and it's more about the idea of the New York Stock Exchange and not actively exchanging shares on the floor. And the fact that the owner of the exchange is trying to diversify into data, which they've been doing for years, becoming basically a data provider, and then into other markets like crypto and prediction markets. Sign of the times, as they say. All right, let's take a question or two here. Yeah, I see some comments about ICE and the Intercontinental Exchange and CME. I mean, remember what I would remind people: those are not they're still exchanges, but they're not exchanges in the idea of a physical exchange, right? I mean, they are basically a market data provider more than anything. Their business is selling the data that the exchange has, and they found ways to turn their old school business into more of a new school business because so many financial firms and investors worldwide rely on data from exchanges, and that's kind of their business. All right, 3P Investor, thanks as always for watching, my friend. And I should notice, by the way, Todd, thank you so much for the kind gesture on my YouTube channel as well. I really appreciate that, you guys. Thanks so much for watching. Thanks so much for taking the time to recognize that with a tip on the YouTube channel. I appreciate that. Thanks for being a part of the community. Come back tomorrow. Bring a friend. I appreciate you guys very much. 3P Investor, you're asking your cheat sheet for differentiating a tactical pullback, a potential correction, and signs of a deep correction. Yeah, when in doubt, zoom out. That's one that's thrown around a lot. I mean, most recently, I'm trying to think of who that was. Jeff Hughes. That's who mentioned that. That's who comes to mind as mentioning that. I feel like the last time I interviewed him, or at least times I've interviewed him, he loves to throw that quote around. That's one it's one of those classic market maxims that get thrown around. And I love that one, right? I mean, anytime you're looking at a chart and it feels like you're struggling to just understand what it means, bring in more data, zoom out a little bit, go from a daily to a weekly, go from a weekly to a monthly, go from a 5-minute to an hourly on any time frame, go up one level, bring in more data, bring in a couple more periods, increase the look back period. And that's just going to help you put what you're seeing right now into the context of the longer term trend. A lot of things, when they're unclear on one time frame, will make a lot more sense when you zoom out a little bit. So that's a good one. I'm a huge fan of that one. Please use it and tell your friends. So what are the way? I mean, that's a whole day long event. And at some point I will do the Dave Keller come spend a day and we'll talk about some strategies for analyzing the markets, like a day long boot camp on the wish list of some of things. And at some point I'll figure out a way to do that. And I'll let you guys know. Would love to meet some of you there for sure. That's the kind of thing we would spend the day pulling out. So what are some initial comments that I would tell you about that? So I am a huge fan of making life easier, right? A lot of the times I talk about, mindful investing, which is basically, look, make things easier on yourself. When you have something that's working, Don't spend a moment of your time analyzing and trying to identify how or why it should keep working. I assume that a trend is going to continue until the trend is no longer continuing. So I'm going to spend my time just creating a structure, creating a framework with which I can define or where I can recognize that a trend is no longer happening. So when something's just in a big downtrend, I figure out what would tell me that this downtrend is no longer in play. One of the things I look for, like daily or weekly MACD buy signals with things that are just in a downtrend. Just wait, like don't touch it, don't even worry about it until we get a buy signal, which would tell you at least some sort of accumulation is happening. And so that's a way to just not keep trying to bottom fish, not lose your shirt, buying things going down. You just wait for the sign that it's not going down anymore. And I think the opposite would happen here with things like the GDX or any things that have been in strong uptrends. A lot of growth names have this kind of vibe. The 21-day exponential moving average, the chandelier exit system. Those are my two favorite ways of just kind of fix it and forget it, put it on the chart, put it in a scan and just say, look, tell me when this thing breaks. And until it does, I shouldn't be worrying too much about it. I'm going to assume that this trend in gold and gold stocks keeps going. At some point it won't. At some point it will top out, and I'll be looking for a signal on a chart like that. So that would be my initial, like, all right, we're in some sort of pullback. Now, how do you differentiate a tactical pullback versus more of like a cyclical correction? How do you differentiate a cyclical correction versus a secular change, right? A real shift, a change of character. This is where we have to use the tools of the technical toolkit. And I would say the cool thing about having a series of moving averages is that you can start to make that assessment a little bit better. One of the degrees that I think about, sort of like a first degree pullback, holds the 21-day EMA. That's just noise. A kind of second degree pullback gets to the 50-day moving average, but doesn't get much further. A real decline, the 200-day moving average is in play. That's one way to kind of think of it, right? With a simple structure, just using multiple moving averages. For me, though, when we sort of break the 21-day EMA, that's when I feel like you have to kind of step in and take action. And I'll finish. I'm going way long because I'm all wordy because I haven't been doing a show for a couple of days. So I got all these ideas bouncing around in my head. I'll calm down here through the course of the week, folks. But I would say this, right? Think of it like a pilot, right? An airline pilot, like a commercial pilot, most of the time they are not flying the plane, right? George is flying the plane, which is the slang for the autopilot. You put the autopilot on, I mean, soon after you take off, they literally get you until you're right over the ground, and then you're taking control again and doing the little things to do it. But the plane can fly on its own, right? Using a good autopilot. At least a decent plane would be able to do that. So, when would a pilot take control outside of that? What's if something different happens, right? So the pilot is taught, when do I need to disable the autopilot? When do I need to take back control of the plane? Because you need to address a situation. And that's what I think of breaking the 21-day EMA. Above the 21-day EMA, the autopilot's flying and it's good. Why worry about it? Like, it's fine. I mean, could I question how the autopilot is doing? I mean, maybe, but it's like, it's fine. If we break the 21-day EMA, I want to take control of the plane, which means I'm not just going to passively watch for a moving average. Then I'm going to analyze momentum. I'm going to analyze relative strength. I'm going to look at for potential divergences. I'm going to look at some other indicators to say, are we seeing any sort of validation or confirmation, any agreement or disagreement? That's where I feel like your job as a pilot is much more active. For a lot of investors, I think, when things are good, you're more in autopilot mode. And don't be afraid to be in that mode. That's a good thing. Hopefully that happens more than it doesn't. Good questions. And sorry for rambling, but thanks so much for watching today. As a reminder, I will be at the Money Show next week in Orlando. That's October 16th and 17th. I'll be there Thursday and Friday. I hope you can attend. You can find more information at marketmisbehavior.com/money show. You can sign up to attend the event there. If you do attend, please make sure you attend my session. Come and say hello. I'm actually going to have an exhibit in the exhibit hall with a little exercise for investors, a little mindfulness exercise. So swing by and say hello to me there. I'd love to say hello to you. But for now, I'll say have a wonderful evening. Thanks so much for joining today. And remember, it's always a good time to own good charts. Take care, folks.